So in the last class, I introduced two approaches to help the managers to make capital investment decisions. However, as I introduced, that the two methods introduced in the last class ignore the time value of money. Today, I'm going to introduce another two approaches to assist managers to make capital investment decisions. While these two approaches consider the concept of time value of money. So before the introduction, I would like to introduce the concept of time value of money. What is that? It simply means a dollar received today is worth more than a dollar to be received in the future, because you can learn today's dollars and earn additional interest. So you'll have more cash in the future. So this fact that invested cash earns interest over time is called time value of money. Simply speaking, this concept, the time value of money, considers the existence of interest. This concept explains why we would prefer to receive cash sooner rather than later. The time value of money means that the timing of capital investments net cash inflow is important. And the two approaches that will be introduced today are NPV, which stands for net present value, and IRR, which stands for internal rate of return. So here, regarding to time value of money, I would like to introduce another three concepts. One, the principal amount, which is short for letter P. The principal refers to the amount of investment or borrowing. Because this chapter deals with capital investment, we will primarily discuss the principal in terms of investment. We state the principal as either a single lump sum or an annuity. Well, for example, if you win the lottery, you have the choice of receiving all the winnings now, or receiving a series of equal payments for a period of time in the future. So these two concepts illustrate the concept of lump sum and annuity. If you decide to collect all the winnings now, it is a way of lump sum receipts. Or if you decide to receive a series of equal payments for a period of time in the future, that means annuity. So again, annuity is a stream of equal cash payments made at equal time interval. Concept number two, the number of periods, which stands for the letter N. It means the length of time from the beginning of the investment until termination. All else being equal, the shorter the investment period, the lower the total amount of interest earned. If you withdraw your savings after 4 years rather than 5 years, you will earn less interest. And in this chapter, the number of periods is stated in years. Concept number 3, the interest rate, which is represented as the letter I. Interest rate is the annual percentage earned on the investment. Interest can become computed as either simple interest or compound interest. Well, here I would like to let you know that the interest rate is often represented as annual interest. So that's why I said that in this chapter, the number of periods, the N, is also stated in years. Well, I just said that there are 2 methods to compute the interest rate: simple interest and compound interest. Simple interest means that the interest is calculated only on the principal amount, where compound interest means the interest is calculated on the principal and on all previously earned interest. So here, compound interest assumes that all interest earned will remain invested and earn additional interest at the time, at the same interest rate. So let's take this slide as an example to illustrate in a simple interest and compound interest. On this slide, if you look at the second and the third columns, it is the calculation of simple interest with an initial investment amount to be $10,000. For the first year, using simple interest, the interest is calculated using 10,000 times 6%, which is the interest rate. And in the second year, the calculation is exactly the same as the first year. Same in the third year, same in the fourth year, and same in the last year. This is simple interest calculation. While on the fourth and fifth columns, you can see for the first year, the calculation is the same as simple interest, while in the second year, the calculation is different. It uses the initial investment, which is $10,000, plus the interest earned in the first year, which is $600. Well, this $600 comes from the interest earned in the first year. So that's the theory behind compound interest. I said the compound interest means the interest is calculated on the principal and on all previously learned interest. For the principal amount in the third year, it uses the initial investment plus the interest earned in the first year plus the interest earned in the second year, which is $636. So this is the difference between simple interest and compound interest. Well, in fact, most investments use compound interest instead of simple interest. So we would like to assume compound interest is used for the rest of this chapter. Next, I would like to introduce future value and present value factors. The future value and present value of an investment simply refers to the value of an investment at different points of time. We can calculate the future value or the present value of any investment by knowing three things. First, we need to know the principal amounts. Second, we need to know the number of periods. And lastly, we need to know the interest rate, which are the three factors I just introduced. So present value, future value simply equals to present value plus interest earned. So let's take a look at this example. If we invest $10,000 today, its present value is simply $10,000. If we know that the interest rate is 6% and this investment lasts for 5 years, I'm going to ask you, what is the future value of this investment? So the calculation is simple. We use future value equals to present value plus interest earned. We know the present value or the principal equals to 10,000. This number is given. The interest earned is a little bit difficult to be calculated, which is 3,383. So our K is how to get to know this number, the interest earned. Well, actually, we can use 4 tables provided in the appendix A of this textbook to help us to calculate this interest earned. The first table is present value table. Second is present value of ordinary annuity table of $1. Third table is future value table. And the last table is future value of ordinary annuity of $1. Well, in this section, I would like to present these four tables here. Well, here it is. This is the first table, present value table. Second one, third one, and fourth one. So let me show you how to use this table to do the calculation. Well, for example, let's go back to our question. Now we know these three factors. The first factor is principal, which is $10,000. The second factor is 5 years. And the third factor, interest rates, is 6%. So we would like to find the present value, the future value factor from the future value table. The period is 5 years. And the interest rate is 6%. So we need to find this value under the intersection of 6% to be interest rates and 5 to be the periods. And we simply use this factor times the initial investment, which is 10,000. So we use 10,000 times that factor. We get the future value to be $13,383. Well, similarly, we can also use the present value table to calculate the present value. Well, for example, now I know the total money I can earn in the future during 5 years is $13,383. And I know the interest rate is 6%. I'm asking you the present value. How much I need to invest in to earn $13,383 in 5 years with an interest rate to be 6%. So in this case, we need to find the present value factor in present value table and use that factor times 13,383. So we find the interest rate to be 6%, number of periods to be 5 periods. Well, that number is right here. 0.747. We use this number times the future value. And then we can get 10,000 to be the present value. Well, here is the present value of lump sum and future value of lump sum examples. Now, let me show you how to use table 2 and table 4. These two tables are about present value and future value of an annuity. All right, now let's assume the interest rates of receiving well, now let's assume instead of receiving the lump sum at the end of 5 years, you will receive $2,000 at the end of each year. So this is a series of equal payments over equal intervals. So this case is considered an annuity. So now I'm going to ask you, how much would you have to invest today to receive these payments, assuming an interest rate to be 6%? We determine the annuity present value factor from the second table. Present value of ordinary annuity of $1. This table. Well, we look down the 6% column and across the 5 periods row, we can find the present value factor is 4.212. Here it is, 4.212. So using this factor, we can finish the calculation. Well, I believe the slides has an error. I mean, here, instead of using 5.637, we need to use 4.212. And the results should be 8,424. All right. This is an example of future value. of Annuity. So now I have demonstrated the use of these two tables. Let's think of an example. That is the lottery. For example, you win a lottery and now you have three options. Option number one is to receive the lottery at one time now. And lottery number two, your option number two is to receive $150,000 at the end of each year for the next 10 years. And option number three is to receive $2 million at the end of 10 years. So which option would you choose? All right, now you need to know the payment type of these three options. For option one, the payment type, it means that you receive $1 million as the present value now. And option two is that you should receive $150,000 as an annuity. And option number three is a lump sum future value of $2 million. So which option would you choose? Depends on the present value of each option. So for option one, the present value is simply $1 million. It doesn't require process. Well, for option number two, its present value is calculated using the annuity, which is $150,000 times the annuity present value factor, where interest rate is 8% and periods to be 10. In that case, the present value is 1,006,500. And for option number three, it is actually $2 million. $2 million as future value in lump sum. So to calculate the present value, you can use table number 4 and find the present value. Table number 1 to find the present value factor, where interest rate to be 8% and number of periods to be 10 times $2 million. And then you can get the present value to be only $926,000. So by comparing the present value of these three options, option number 2 is actually has the greatest value. And option number 2 is the best one. So this problem is a good example of how business use discounted cash flows to analyze capital investments. Companies make initial investments. The initial investment is already in present value, similar to option 1 in this example. The purpose of the investment is to increase cash flows in the future. But those future cash flows have to be discounted back to their present value in order to compare them to the initial investments already in the present value, like option number 2 in this example. And some investments also have a residual value, which means the company can sell the assets at the end of their useful lives and receive a lump sum cash inflow in the future. So this is similar to option number 3. Well, this is the introduction of time value of money. So, all right, let's continue our discussion of the 2 methods used for capital investment decisions that consider time value of money. These 2 methods are NPV, which stands for net present value, and IRR, which stands for internal rate of return. As I said, these 2 methods rely on present value calculations to compare the amount of the investment with its expected net cash flows. If the present value of the investment's net cash inflows exceeds the initial cost of the investment, then that's considered to be a good investment. Net present value is a capital investment analysis method that measures the net difference between the present value of an investment's net cash inflows, and the investment's initial cost. Now, let's consider an example. And I'll use this example to illustrate NPV. The company, the smartest learning company, it is considering expanding production to include laptop computers and desktop computers, with each product considered a separate potential capital investment project. The project each require the purchase of one specialized machine. Each machine costs $1 million, and it has 5 years life with no residual value. And the two projects have different patterns of predicted net cash inflows, which is listed in on this slide. As you can see on this slide, the laptop project generates more net cash flows, but the desktop project brings in cash sooner. So, from the first glance, our decision is on laptop projects simply because it generates more cash inflow. But we need to consider time value of money to see if the sooner cash inflow brings in is more benefit. So here, as I said, we need to use NPV to help us to make decisions. We need to discount the net cash inflows using the company's minimum required rate of return. Well, this rate is called discount rate because it is the interest rate used for the present value calculations. The discount rate is the interest rate that discounts or reduces future amounts to their lesser value in the present. It is also called, sometimes it's also called required rate of return or hurdle return, because the investment must meet or exceed this rate to be acceptable. The discount rate depends on the riskiness of investments. The higher the risk, the higher the discount rate will be. And this rate is kind of arbitrary. So let's assume that the discount rate required by smart touch learning is 14%. And next, we compare the present value of the net cash inflows to the investment's initial cost to decide which projects meet or exceed management's minimum desired rate of return. In other words, the management is deciding whether the $1 million investment is worth more, or whether the project's future net cash inflows are worth more. All right, first of all, let's see a case of NPV calculation with equal periodic net cash inflows. That is actually the laptop projects. That project is expected to generate 305,450 of net cash inflows each year for 5 years. Because these cash flows are equal in amount and occur every year. So it's considered an annuity. we use the present value of ordinary annuity of $1 table to find the appropriate annuity present value factor for interest rates equals to be 14% and number of periods to be 5. Well, by looking at that table, in the table number 2, interest rates is 14 and periods is 5. Well, this factor, interest rate to be 14% and periods to be 5, is 3.433. Well, we can simply use net cash inflow times this factor. We get the present value to be this number. And we use the present value minus initial investment, $1 million. We get the NPV for laptop project. It is 48,610, which is a positive number. So a positive NPV means the project earns more than the required rate of return. Well, this is the case with equal periodic net cash inflows. And we use that laptop computers projects as an example because it yields equal net cash inflows each year. But what if we have a case with unequal periodic net cash inflows? So in contrast to the laptop projects, the net cash inflows of desktop projects are unequal. As you can see, $500,000 in year 1, $350,000 in year 2, and so on. Because the company expects to have higher sales volume in the early years of the projects than in later years. Because these amounts vary by year, the company manager cannot use the annuity table to compute the present value of the desktop. Instead, they must compute the present value for each individual year's net cash inflow separately. So that means the calculation needs to be done for 5 times for each year. And we do not use the annuity present value factor table. Instead, we use the lump sum present value factor table. I mean, table one. And you need to find the present value factor with interest rate to be 14% and number of periods to be 1 and 2, 3, 4, and 5 separately from that table. You do the calculation for 5 times and sum up the result. Sum up these present value results and you get total present value of net cash inflow. And then minus initial investment, which is $1 million. You get the NPV for desktop project. 78,910, which is still a positive number. Well, as you can see, the NPV for both projects are both positive. So that indicates that both projects are attractive. So here is the decision logical tree for NPV. If the NPV is positive, we invest in these products. Otherwise, if NPV is negative, we do not invest. Well, these two examples, as I said, do not have residual value. But in fact, many assets yield cash inflows at the end of their useful lives because they have residual value. Companies discount an investment's residual value to its present value when determining the total present value of the project's net cash inflows. The residual value is discounted as a single lump sum because it will be received only once. I mean, when the asset is sold, it is received. So let's look at this example on this slide. Let's suppose that Smartest Learning expects the laptop project equipment will be worth $100,000 at the end of its 5-year life. To determine the laptop project's net present value, we discount the residual value of $100,000 using present value of $1 table. I mean the first table. We find the present value factor with interest rate to be 14% and number of periods to be 5. It is actually 0.519. We use this factor times its residual value. We get the present value of residual value of these assets to be $51,900. We simply sum up the present value of annuity with the present value of residual value. We get the total present value of cash inflow. And then we minus its initial investments, which is $1 million. Finally, we get the net present value of these projects. Well, if the company had to choose between these two projects, the company would choose the desktop projects in the first scenario because it yields a higher NPV. And the laptop project in the second scenario because it yields a higher NPV when the residual value is considered. But comparing the NPV of those two projects is only valid because both projects require the same initial cost. So in contrast, this slide summarizes 3 capital investments options faced by the company. Each capital project requires different initial investments. All these 3 projects are attractive because each yields a positive NPV. Let's assume the company can invest in only one project at this time. So which one would you choose? We can see option number B, project B, yields the highest NPV, but it also requires a larger initial investment than the other alternatives. So to choose among different projects, the company computes the Profitability Index. Well, here, the Profitability Index computes the number of dollars returned for every dollar invested, with all calculations performed in present value dollars. So here, Profitability Index equals to present value of net cash inflows divided by initial investment. This index allows us to compare alternative investments in present value terms, but it also considers differences in investments' initial cost. So let's compare the profitability index for all these 3 alternatives. We can see that the profitability index shows project C is the best of these three alternatives because it returns $1.21 for every $1 invested. So using Profitability Index as a tool of choosing alternatives. Now let's compute the Profitability Index for these two projects fixed by Smartest Learning computer. Laptop projects and desktop projects. So the Profitability Index confirms our prior conclusion that desktop project is more profitable than the laptop projects. That because the desktop project returns $1.079 for every $1 invested. We did not need the profitability index to determine that the desktop project was preferable because both projects required the same investments. Because the company chose desktop over laptop, the NPV of the laptop project is the opportunity cost. And the opportunity cost is the benefit foregone by choosing an alternative course of action, as you learned in the previous chapter. Well, this is NPV. The last thing I will discuss is IRR. Well, IRR is actually the rate of return of capital investments. It is actually the interest rate that makes the NPV of the investments equal to 0. So when net present value is calculated, the present value factor is selected using the company's required rate of return. If the net present value is positive, then the actual rate of return is greater than the required rate of return, and it is an acceptable project. But you do not know the actual rate of return. The only thing you know is that it is greater than the required return. If the net present value is 0, then you can know the actual return is equal to required return. The actual rate of return is called internal rate of return. In other words, the internal rate of return is the interest rate that makes the initial cost of the investment equal to the present value of the investment's net cash inflows, which means the net present value is 0. Basically, the higher the IRR, the more desirable the project is. So now let's look at this example. let's consider the laptop project, which would cost $1 million and result in 5 equal yearly net cash inflows. So we compute the IRR of an investment with equal periodic cash flows by taking 4 steps. First, since the IRR is the interest rate that makes the cost of investment equal to the present value of the investment's net cash inflow, we set up this equation. Annuity present value factor equals to initial investments divided by amount of each cash inflow. Second, we plug in the information that we know. Well, here in this case, the information we know is the investment to be $1 million and the equal annual net cash flows. We divide the initial investment by net equal cash payment in each year. We get the annuity present value factor to be 3.274. Step 3. We need to rearrange the equation and solve for the annuity present value factor. And in this case, we know this factor is 3.274. So actually, the IRR in this case is the question mark here. We need to know the interest rate that corresponds to this annuity present value factor. So finally, we need to find the interest rates from that table. We need to find the present, we need to use present value of ordinary annuity table. That is table number 2. All right, right here. We know the number of periods is 5. So from this row, we need to find our net present value factor. That is 3.274. All right, it is here. Here it is. And we can see that this rate has the interest rate, this factor corresponds to the interest rate to be 16%. So in this case, we know So in this case, we know that the IRR is 16%. Or in other words, 16% is the discount rate that makes the investment cost equal to the present value of the investment's net cash inflows. Well, this is the case with equal periodic net cash inflows. So what if we have unequal periodic net cash inflows? Because desktop projects, has unequal cash inflows. The company cannot use the present value of ordinary Annuity $1 table to find the asset's IRR. Rather, the company should use a trial and error procedure to determine the discount rate, making the project's NPV equal to 0. For example, because the company's minimum required rate of return is 14%, the company might start by calculating whether the desktop project earns at least 14%. The NPV calculation that the desktops for the desktops using a 14% discount rate is, if you can recall, that was $78,910. Because the NPV is positive, the IRR must be higher than 14%, right? So the company continues this trial and error process using higher discount rates until the company finds the rate that brings the net present value of the desktop project to be 0. Well, this slide shows the NPV calculation using the discount rates of 16% and 18%. And at 18%, the NPV is almost 4,000. That is $3,918. You see, this number is very close to 0. So the IRR must be slightly higher than 18%. So using this method, you can determine the IRR with the case where the project use unequal periodic net cash flow. But you may ask that for most cases, the present value annuity factor do not appear in our table. What can we do? Well, actually, the solution provided in this textbook is to suggest you using the business calculator or computer software programs to assist you to calculate the IRR. Many computer softwares such as Excel has the function, has this feature to help you to get the IRR of a specific project, providing the information that you know. So this is the logical decision tree for the use of IRR. If the IRR meets or exceeds the required rate of return, the management decides to invest in. Otherwise, if the IRR is less than the required rate of return, the management doesn't need to invest in this project. All right, so this is the end of this class. And also, this is the end of this course in this semester. Same thing, please let me know if you have any questions before I leave. Nope? All right, I would like to say it's been a great pleasure to be with you guys. Even though we do not have the opportunity to meet face to face, but it's still been a great pleasure to have you on my online classes. I would also have the lifetime assistance policy. That means if you have any future questions, either in your life or in your future works, please feel free to reach me out, and I'm always help to assist you. So I hope we can see each other very soon in the upcoming semester, and I would wish that things will turn to a positive way in the upcoming future. All right, thank you guys. And again, I would like to thank you for your attendance in every class. So bye-bye.
Professor, have a good one.
You too. Thank you. Bye-bye.
Professor, good night.